Next question. ABC Limited, a large business house, is planning to sell its wholly owned subsidiary KLM. So KLM is a company which is the subsidiary company of ABC, and ABC company wants to sell its wholly owned subsidiary. Another large business entity, XYZ, has expressed its interest in making a bid for KLM. It means that so the XYZ is acquiring company and KLM is target company. Okay, this is acquiring company and this is target company. XYZ expects that after acquisition, annual earning of the target company KLM will be increased by 10%. Following information, ignoring any potential synergistic benefit arising out of possible acquisition, are available. Profit after taxes for KLM for the financial year which has just ended is estimated to be rupees 10 crore. So this is of year 0. KLM's after tax profit has an increasing trend of 7% per year. So growth rate is given. And the same is expected to continue. Estimated post-tax market return, that is RM, is 10%. Risk-free rate of return is 4, that is RF. These rates are expected to continue. Income tax rate is 30%. Okay. Now the question is providing the information. XYZ ABC and proxy entity for the KLM in the same line of the business. Now, dear students, what does the term proxy entity mean? It means that's a company which is doing similar business as what the XYZ is doing. As what the KLM is doing. I give you an example, something like this. Let us say that Infosys is going to enter into hospitality sector in a way that it is going to enter into, let us say that's the hotel end of the business. Now listen carefully. Whatever the required rate of return that Infosys would have from its existing line of the business, the same cannot be the expected rate of return from the new line of the business. Why? Because the pros and cons of the existing line of the business of IT sector and of hospitality sector are different. That is the reason what Infosys will do. Infosys will take into account one of the existing company dealing in hospitality sector as a base to determine what is the rate at which I require the return from the new line of the business. So in that case, let us say that it takes Oberoi group of the hotels as a proxy entity. Whatever the required rate of return that Oberoi group of hotels would have from the new line of from the line of the business will be taken into account, will be taken as a base for determining the required rate of return that Infosys will have from new line of the business. That is what we understand. And that is the reason there is a need of the proxy entity. Now understand carefully, friends, as per the given information, that what will happen? XYZ is going to acquire KLM. In order to determine what is the rate at which the XYZ will have its required rate of return from KLM, what they will do, they will take one of the proxy entity as a base. It means a company which is doing similar business as what the KLM will be taken as a base to determine the required rate of return. And that is what the reason with which we have been provided with the proxy entity information. Okay. We have been provided with the information about the dividend payout ratio, that is 1 minus B. That is provided to us. Then we have been provided with the information debt equity at market value, that is 1:4. Then the price earning ratio is given to us, it is 12. Then equity beta information is given. Assuming gearing, gearing stands for introduction of the committed sources of the finance in the capital structure. Assuming gearing level of the KLM, that is target company, is the same as of ABC Limited. So whatever the capital structure which holding company has, similar is the capital structure of the subsidiary company. And the debt beta is 0. Dear students, this information is not required to be given because this is assumed otherwise. That always the beta of the debt financing would be 0. You are required to calculate appropriate cost of equity, that is K, for KLM, that is for the target company, based on the data provided, very importantly, for the proxy entity. Because what will happen, understand carefully, that say whatever the kind of risk which the proxy entity is facing in that line of the business, same kind of the business, that is same kind of the risk XYZ is going to have once they will take over the KLM. What will happen, friends? We understand like this. XYZ is acquiring company. It is going to take over KLM. Let us assume that the XYZ is right now in electronic line of business. Now it is going to enter into pharma line of the business. So what XYZ has done, XYZ has taken the Rheinbexy company into account. Let's say what kind of the capital structure that Rheinbexy is having, what kind of the beta that the Rheinbexy is having. So taking into account these details, we will determine what is the required rate of return of KLM. That is what we understand. Dear students, this point is understood by us in detail when we learn our chapter called Portfolio Management, a very simple chapter. And in that we have a concept which is given a name as beta of unlevered equity. Why it is called beta of unlevered equity? That is also what we are going to discuss, in that portion. This is the reason that we have been provided with the proxy entity information. I give you a little explanation about this concept. Dear students, we were learning a concept which was given a name as net operating income approach with taxes. Net operating income approach of capital structure theory with taxes. In case of NY approach, we had a kind of situation like this. Listen carefully. This is cost of debt financing. This is cost of equity. And this is weighted average cost of capital. On x-axis, we take the debt financing in the capital structure, and on y-axis, we take the cost of capital. When there is no debt financing, then in that case, the cost of equity and weighted average cost of capital are same. When you increase the debt financing, then risk for the equity shareholder increases. So the required rate of return for the equity shareholder increases. So you have this level of the debt financing, then this is your cost of equity. We know that cost of equity can be calculated by multiple methods, but looking at the information over here about RF, RN, beta, we have to apply CAPM, that is RF plus beta into RN minus RF. Now listen carefully what I am going to speak. The proxy entity of the KLM means Rheinbexy company in the conversation that we have is having this amount of the capital structure. However, we are going to have the capital structure let us say equal to this, or it may happen that say we are going to have the capital structure equal to this. In that case, we will be having say the different cost of equity. That is the reason so the question says that in the first part of the question, calculate the appropriate cost of equity for the KLM. That is what we are required to calculate using the capital structure of the KLM. For that, first of all, we will make the calculation of this value. This is what we understand is the cost of equity for unlevered capital structure. Means if at all there is no debt financing. This is what's the cost of equity that you have. This. Now you are going to have the debt financing. Then in that case your cost of equity is going to be this. Your cost of equity is going to be this. This is the way we are required to make the calculation of the cost of equity say for the different capital structure. So what is the debt financing that say we are going to keep? That is also provided to us an example, and accordingly we are required to calculate the answer. So first of all, we'll make the calculation of the beta of unlevered equity using the proxy form information by using a very simple formula which we are going to learn in our very simple chapter called portfolio management. So let us answer for the A part of the question. In that, write down calculation of appropriate KE cost of equity for KLM. Based on data available for proxy entity. In that, write down step number 1, calculation of beta of unlevered equity. So it is beta of levered equity divided by 1 plus debt into 1 minus tax rate divided by equity. This is a simple formula that we are going to learn in our very simple chapter called portfolio management. So beta of unlevered equity, this is beta of levered equity. Levered means debt financing is there. D stands for the debt financing and E stands for the equity financing. That is what we understand. Now we can say that as far as the proxy entity is concerned, in that we will be having the working like this. Debt equity is provided to us 1:4 and the equity beta is given as 1.10. So we understand something like this. Debt equity is 1:4. I am focusing on the target company right now. So the total is 5. So this is 0.20 and this is 0.80. Beta of levered equity is given to us as 1.10. So dear students, this will be taken beta of levered equity as 1.10 divided by 1 plus Debt financing proportion is 0.20. Income tax rate is provided to us as 30% divided by the equity financing. Equity is 0.80. Okay. 1.10 divided by. So friends, what will happen? 1 minus 0.3 is 0.7. 0.7 into 0.2, that is 0.14. 0.14 divided by 0.8. 0.175. So it is 1 plus 0.1750. So it is 0.9362. This is the way the beta of the levered equity is unlevered equity is calculated if at all there is no debt financing. So step number 2, calculation of beta of levered equity. Now in that we understand like this. Beta of unlevered equity is equal to beta of levered equity divided by 1 plus debt into 1 minus tax rate divided by equity. This is the formula that we will have. Now this is required to be found by us. So beta of levered equity is equal to beta of unlevered equity into 1 plus debt financing. We have been provided that so the capital structure of the KLM is same as of the ABC. So as far as ABC is concerned, its debt equity ratio is given as 1:3. So what will happen, we understand it is debt equity 1:3. So the total will be 4. So 1 divided by 4 is 0.25. 3 divided by 4 is 0.75. So now what will happen, dear students? Debt financing is 0.25. Income tax rate is 30%. Whole divided by equity. Equity is 0.75. Okay. Now what is the beta of unlevered equity? It is 0.9362. So now it is 1 plus, see 0.25 into 0.7, it is 0.175 divided by 0.75. So it is 0.23333, something like that. So I'm writing over here directly into 1.2333, like that. Okay, how I have made calculation, friends? I made calculation of this component. 1 minus 0.3 is 0.7 into 0.25. So 0.175 is the numerator divided by 0.75. So 0.23333, like that. 1.23333 into 0.9362. So 1.1546. That is the way the beta of the levered equity is calculated. You can understand logically, friends, that proxy entity had 20% debt financing. KLM has higher debt financing. More debt financing, more risk. So the beta of the equity is more. Finally, calculation of cost of equity. It will be like this: RF plus beta into RM minus RF. This is a formula to be applied. Risk-free rate of return is given to us. It is 4%. Return on the market portfolio is given to us as 10%. So taking into account this RF, RM, beta, will make the calculation of K. So now risk-free rate of return is 4. Beta is 1.1546. Return on market portfolio is 10. Risk-free rate of return is 4. So 6.93 is added to 4. 10.93. That is the way the cost of equity is calculated in the first part of the question. Second part of the question. Second part of the question says that you are required to compute range of the values, range of the values for the target company both before and after any potential synergic benefit to acquiring company or on the acquisition. You can see that the language of the question speaks like this, that XYZ Limited expects that after acquisition, annual earning of the KLM will increase by 10%. So the question says that you are required to give the range of the value of the target company, that is KLM, considering say this increase in the earning, that is potential synergic benefit, and ignoring it. So there are two questions that say, that is say the two times we are required to give the range, considering the advantage and ignoring the advantage. That is what we understand. Friends, over here information is provided to us that the profit after taxes of KLM is an amount of rupees 10 crore. And we have been provided with the information about acquiring company details and the target company details. Everybody is requested to have understanding that's how to do answer for the question. Dear students, over here, first of all, I am giving explanation as if there is no synergy gain. Okay. In that case, I am doing the calculation of the answer in this way. Using the price earning ratio method and using the dividend discount model approach method. By two ways, I'll do the valuation of the target company. Okay. Now for the price earning ratio, we can take the price earning ratio of XYZ and we can do the valuation of the KLM. What is the price earning ratio? It is 10. What is the earning of KLM? It is 10 crore. So it is 10 crore earning into 10 times price earning ratio. So this is the value using say the XYZ information. Now using the proxy entity information, the price earning ratio is 12. So what will happen? Again 10 crore into 12. This is 120 crore. So these are the two valuations that we do of target company based on the price earning ratio method, price earning ratio of XYZ and price earning ratio of the proxy entity. Now dividend discount model approach. In that we understand like this. We have been provided with the information about the growth rate of 7%. So we do answer in this way. As far as the dividend discount model approach is concerned, in that say we work out the answer by using the formula like this. P0 is equal to D1 divided by K minus C. This is the formula that we can apply. What is dividend? It is earning into dividend payout ratio divided by cost of capital minus growth rate. This is what we understand. Dividend discount model approach, in that say using the dividend payout ratio of XYZ Limited. We have been provided that say the XYZ Limited has dividend payout ratio of 40%. So we can work out the answer like this: 10 crore into 1.07. So this is earning at the end of year 1 into 0.40. That is dividend payout ratio divided by cost of equity, which we have recently calculated. I think that it is 0.1093. Yeah, that is the cost of equity minus growth rate 0.07. So this will give one more valuation of the, that is the KLM, using dividend discount model approach, in which dividend payout ratio of XYZ Limited is taken. So 10 into 1.07 into 0.4 divided by 3.93%. So it is 108.91 crore. Now using the proxy entity, again friends, story will be same: 10 crore into 1.07 into dividend payout ratio is 50%. Okay, for the proxy entity, dividend payout ratio 50%. So into 0.5 divided by cost of capital less growth rate. This is the way we are required to do answer. So 10 into 1.07 into 0.5 divided by 3.93%, that is 136.13 crore. So these are the four valuations that say we have of target company if there is no synergistic gain with the different methods. Now you may have a question. That's where the question is providing that we have to do the valuation using price earning ratio. Where it has been given, we have to use the dividend discount model approach. Where it has been given, say you have to take XYZ proxy entity. Giving reply to all these questions that say you may be having. Dear students, as far as this question is concerned, for that say all these informations have not been given expressly in the question. However, the institute has made, that is, has provided the suggested answer using these different methods. What I want to tell you, that's over here, if possible you may have say some other valuation method, but these are the possible methods that say we have which institute has adopted. If somebody wants to have the valuation using the earning capitalization, even in that case it is valid, it is acceptable. So something reasonably that say you have to do the valuation. Okay, once we do all this valuation, we have to locate at what is the least value. The least value is 100 crore. And what is the highest value? 136.13 crore. So range of the valuation for acquisition of the target company without synergy gain is 100 crore to 136.13 crore. This is the way we are required to give the final answer. Now we are required to do answer considering synergy gain. In that case, it's very, very, very simple. Everywhere where we have taken 10 crore, instead of 10 we will take 11 crore, we'll recompute everything, and again the lowest to highest range will be found. Just you are required to take 11 instead of 10 for the purpose of doing answer. Friends, I am not dictating a detailed note with respect to the proxy entity, beta of levered equity, beta of unlevered equity, because all these things are discussed in detail when we do portfolio management. So I am not dictating detailed notes for the same. Let us answer the second part of the question. In order to compute range of value, comma, we use price earning ratio method and dividend discount model, dividend discount model for the purpose of valuation. Full stop. Further, we take into account details of XYZ, comma, proxy entity for valuation. Full stop. Now write down heading valuation of KLM without considering increase in earning. So in that, one is price earning ratio method, another is dividend discount model approach method. That is the way we are required to do valuation. So let us do answer price earning ratio. In that I am writing first of all XYZ. In that we understand, so the formula would be earning into price earning ratio. Earning is 10 crore and price earning ratio of XYZ is 10 times. So this is 100 crore. As far as the dividend discount model approach is concerned, it is D1 divided by K minus C. This is the formula. As far as the D1 is concerned, it is calculated as E1 into 1 minus B divided by K minus C. That is the way the dividend discount model approach is supposed to be applied. The earning is an amount of rupees 10 crore into dividend payout ratio of XYZ Limited is 40%. So 10 crore into 0.40 divided by cost of capital minus growth rate. Cost of capital is 10.93. Growth rate is 0.04. So 0.1093 less 0.04 because growth rate is provided to us as the growth rate is 7%. and in the numerator also 10 crore into 1.07 into zero point 0.4, because the recent year earning is provided to us. So earning at the end of year 1 will be 10 crore into 1.07 into 0.40, that is the dividend payout ratio, divided by KE minus C. This is the way the valuation is supposed to be made. 0.1093 minus 0.07, because the growth rate is given to us as 7%. Numerator is 10 into 1.07 into 0.4 divided by 3.93%. That is 108.91 crore. This is the valuation of the company. The next is we'll use the proxy entity information. Okay. In case of proxy entity, it will be like this. Again, the earning is 10 crore and the proxy entity price earning ratio is 12 times. So 10 crore into 12 times. That is 120 crore. The dividend payout ratio is 50%. So 10 crore into 1.07. This is at the end of year 1 into 0.5 divided by K minus C. 0.1093 less 0.07. So 10 into 1.07 into 0.5 divided by 3.93%. So 136.13 crore. That is the way the valuation is supposed to be made. Now again, lower to higher. So what will happen? This is the lower value and this is the higher value. This is the range of the valuation. Now we will do again this 4 valuation considering synergistic gain instead of without considering. Please do answer on your own, then I'll do answer for you. So now we understand that, say, again valuation of KLM considering increase in earning by 10%. So in that case, once again we will have price earning ratio and dividend discount model approach. For XYZ, the earning will be, that is over here the formula would be like this: earning into P ratio. The earning is provided for the recent year, it is 10 crore, and due to merger it is likely to increase at the rate of 10%. Price earning ratio of XYZ is 10. So 11 into 10, that comes to 110 crore. Dividend discount model approach. In that case, we will have, it is 11 crore into dividend payout ratio is 0.40. That is 11 crore into 1.07. That is growth rate into 0.4 divided by cost of capital minus growth rate. So it is 0.1093 less 0.07. This is the way we are required to do answer. So 10 into, sorry, 11 into 1.07 into 0.4 less 3.93 percentage. So 119.80. That is the valuation of the target company. So we have made the calculation like this. This is 11 crore into 10 times. So I have taken this 11 crore directly over here. So it is earning into 1 plus E into dividend payout ratio. That is the way the dividend payment divided by cost of equity minus growth rate. This is the formula. The next is the proxy entity. In case of proxy entity, using the price earning ratio, that is 12 times 11 crore into 12 times 132 crore. For the next one, it is 11 crore into 1.07 into dividend payout ratio is 50% divided by cost of equity less growth rate. Again the same formula. So 11 into 1.07 into 0.5 divided by 3.93%. So 149.75. That is the way we will have the valuation of the company using the dividend discount model approach. So final answer will be like this. Range of valuation of KLM. In that, ignoring synergy benefit, considering synergy benefit. In that, minimum value and maximum value. Okay. Let us understand and say ignoring the synergic benefit, what is the minimum value and maximum value? Out of this 4, we understand that so the minimum is 100 and maximum is 136.13. That is the way minimum and maximum value is supposed to be calculated. So this is 100 crore and this is 136.13 crore. Considering synergic benefit, again the lowest value is 110 and the highest value is 149.75. These are the values to be considered. So it is 110 and it is 149.75 crore. This is the range of the valuation. So we understand that say the minimum value is 100 crore. If at all we ignore the synergic benefit, and maximum value considering synergic benefit is 149.75. That is what we understand. So summary of the entire answer. In this question we have a concept applicable considering so the beta of unlevered firm, that is the proxy entity information. So basically friends, over here what happens at say using the information about a company which is doing the same type of the business which we are going to acquire, we use that company details for the purpose of determining the discounting factor. The logic is over here that whatever the pros and cons applicable to that proxy entity, the same will be applicable to us. That is the reason. Step number 1 is simple calculation of the beta of unlevered equity. It means that's the beta of equity if there is no debt financing. That comes to 0.9362. Now considering the capital structure of the KLM, calculating the beta of levered equity. Levered means where debt financing is there. It is 1.1546. Using beta of equity 1.1546, cost of equity is calculated. Next is we compute the range of the valuation. In that, so the price earning ratio and dividend discount model approach have been used by us. In that, say we use for XYZ and proxy entity details. Applying the usual formula, so we are required to make the calculation of answer. In case of the synergy gain, we take the earning as 11 crore. The lowest and the highest values are taken, say, as the range of the value for the acquisition, considering synergy gain and ignoring the synergy gain. This is the way we are required to do answer.